You've been told your whole life to save money. Put away some cash for the future, they say. But what if I told you that saving money could actually be keeping you poor? Sounds crazy, right? Here's the shocking truth. Inflation erodes the value of your savings every single year. In fact, $1,000 today could be worth just $500 in 30 years if it's left sitting in a bank account. Let's take it further. Over the past 30 years, the average return on a savings account in the US was a measly 0.06%. That's barely enough to keep up with inflation, which has been averaging about 3% annually. So, even though you're saving, your money isn't really growing. But here's the kicker: you don't have to settle for that. There's a better way to make your money work for you, without having to be a financial expert. In this video, we'll uncover why saving alone is holding you back and reveal what you can do instead to start building real wealth. Ready to stop letting your money lose value? Stick around to find out how value investing and the power of compound interest can change the game for you. Chapter 1. The myth of save first, invest later. Why that strategy is keeping you stagnant. We've all heard it before. Save first, invest later. The idea is simple, right? Put your money away in a savings account and gradually build wealth over time. But here's the truth: saving money alone won't make you rich. In fact, it could be keeping you stuck. Let me explain why. A typical savings account in the US offers an interest rate of just 0.05% annually. In real terms, this means you're losing money over time due to inflation. In 2021, inflation hit 7%, and savings accounts couldn't keep up. So, while your savings might grow slowly, it's not keeping pace with rising costs. Now, think about how wealthy people invest. They don't let their money sit in the bank. Instead, they put it into assets like stocks, bonds, and real estate, things that grow faster than inflation. This is what value investing is all about. Warren Buffett, one of the greatest value investors of all time, once said, "The stock market is a device for transferring money from the impatient to the patient." When you save money, you're essentially locking it in a box, watching it lose value slowly. But when you invest, you're putting that money to work. The goal of investing isn't just to protect your wealth, it's to grow it. So, instead of letting your savings pile up in a bank account, learn how to make it grow by investing in undervalued assets that can increase in value over time. You don't need a lot of money to start, either. With as little as $100, you can start investing in stocks. Compound interest can turn small investments into large sums. So, next time someone tells you to just save, remember this: saving alone won't create wealth. You need to invest it wisely. Chapter 2. The inflation trap: how saving is losing you money without you even knowing. Inflation is a sneaky wealth killer. In simple terms, inflation is when the cost of goods and services rises over time. If you've ever noticed how your dollar doesn't go as far as it used to, you've seen inflation in action. The average annual inflation rate in the US over the past century is about 3%. If your savings aren't growing at least at that rate, you're actually losing purchasing power. Let's do a quick example. If you had $10,000 in a savings account for 10 years, and the average inflation rate was 3%, you'd have the same $10,000, but it would be worth less in real terms. That's because the prices of everything from groceries to housing would have increased, making your money less valuable. What does this mean for you? The more money you save and keep in the bank, the more you lose over time. On the other hand, investing in assets that grow with inflation is how you protect yourself. The stock market, on average, returns about 7% annually after inflation. Value investing allows you to buy undervalued assets that can grow faster than inflation, helping you build wealth instead of losing it. Historically, the S&P 500, a stock market index of the largest US companies, has outperformed inflation year after year. Over the last 90 years, the average annual return for the S&P 500 was 9.8%. This means that if you had invested $1,000 in 1928, it would have grown to over $30 million today. So, while inflation silently eats away at your savings, investing in assets that outpace inflation helps you keep your wealth intact and grow it. It's not enough to just save, you need to make your money work harder for you. Chapter 3. The power of compound interest. Why saving alone doesn't make your money work hard. Compound interest is often referred to as the eighth wonder of the world. Why? Because it's the magic that makes your money grow exponentially. When you earn interest on your investments, and that interest earns interest, your wealth starts to snowball. Let's break it down. Imagine you invest $1,000 at an annual interest rate of 10%. After 1 year, you'll have $1,100. But here's the magic: in year 2, you'll earn 10% on the $1,100, not just the original $1,000. In just 10 years, your $1,000 investment could grow to $2,593.74. That's the power of compound interest. Now, saving money doesn't give you this benefit. In fact, the interest you earn from savings accounts is so low that it barely keeps up with inflation. In other words, your money isn't working for you in a savings account, it's just sitting there, losing value. Value investing, however, taps into this compound power. When you buy undervalued stocks and hold them for the long term, you're not just relying on interest. You're allowing your investments to grow as the companies you invest in increase their value over time. Buffett is a big fan of this idea. He famously said, "The stock market is a device for transferring money from the impatient to the patient." By holding your investments and letting them compound, you can turn a small sum of money into a large fortune. But only if you're investing in assets that have growth potential. A great example of this is the company Coca-Cola. If you had invested $1,000 in Coca-Cola stock in 1980, that investment would be worth over $200,000 today. Why? Because Coca-Cola grew steadily, and its dividends compounded over time. This is the kind of power compound interest can have, if your money is invested correctly. So, the key takeaway? Saving alone won't let your money grow. You need to invest in assets that have the potential to compound over time. That's how wealth is truly built. Chapter 4. Buy low, sell never. Why value investing is the anti-savings strategy for long-term wealth. Value investing is all about finding undervalued stocks or assets and holding them for the long term. The idea is simple. Buy when others are fearful, and hold on until the market catches up with the true value of the asset. Warren Buffett's success story is built on this strategy. He once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Value investing focuses on finding companies that are undervalued, often due to short-term market fluctuations or temporary setbacks. When you invest in undervalued assets, you're essentially buying future wealth at a discount. Over time, as the market recognizes the true value of the asset, the price increases, and you see significant returns. The key here is patience. It's about playing the long game, allowing your investments to grow steadily without getting distracted by daily market noise. For example, consider the stock of Apple. In the early 2000s, it was a company with a promising future but was priced much lower than its potential value. Investors who took the chance to buy when it was undervalued saw huge returns as Apple became one of the most valuable companies in the world. By buying low and holding for the long term, value investors can create a strong foundation for wealth, much more reliable than saving alone. Investing in undervalued assets and holding them allows your wealth to grow over time. Patience is key to this strategy. Chapter 5. Money wants to move. How stagnant cash is a silent wealth destroyer. Money that just sits still is doing nothing for you. When it's not invested, it's losing value due to inflation, and you're missing out on opportunities to grow your wealth. Instead of letting your cash stagnate in a low-interest savings account, think of ways to move it into investments that can yield greater returns. One of the best places to start is by looking for undervalued assets in the market. Stocks, real estate, or even peer-to-peer lending can offer greater returns than a savings account, especially when compounded over time. Let your money move and multiply. Just like a river flows and grows, so should your money. Instead of saving to stay safe, invest to create opportunities for future growth. Chapter 6. Turning cash into capital. How value investors unlock their money's true potential. Value investing is about turning cash into capital that works for you. By investing in undervalued assets that grow over time, your money starts to build more money. It's not just about saving and hoping for the best, it's about finding the right investments that can turn your money into a lasting legacy. The best part? You don't need to be a Wall Street expert to start. Begin small, and as you learn, grow your portfolio. Read, research, and stay informed about the companies and assets you invest in. Start today, and over time, you'll see your cash grow into real capital. Remember, it's not how much you make that matters, it's how much your money makes for you. If you found this helpful and want more tips on how to build wealth through value investing, hit that subscribe button and turn on notifications so you never miss an update. Your financial future starts now.